The Nigeria Deposit Insurance Corporation last week commenced the closure of 42 microfinance banks whose operating licenses were recently revoked by the Central Bank of Nigeria, and also carried out verification and payment of their respective depositors and their insured sums. Now, the exercise lasted from Monday, December the 21st till Thursday, December the 24th. And with me here is the Director, the Special Insured Institutions Department of the NDIC, Joshua Etopidiok, who will be giving us updates on how claims of verified depositors were sorted and other key issues regarding insuring depositors' monies in banks and other financial institutions. Good morning, sir. Thank you for coming on the program.
Good morning, madam.
All right. Now, we know how customers usually panic when announcements like this make the news. I mean, give us details of how far the verification and payment process has gone on so far.
Thank you very much. You realize that bank liquidation is one of the core mandates of the NDIC. Having said that, to do this seamlessly, we have to work in close collaboration with the central bank. So immediately, the decision was taken that the licenses of the 42 MFBs be taken. The corporation was informed, and the necessary statutory measures in terms of gazette was received. With that, we liaised with the police and the appropriate departments in NDIC, the Claims Resolution Department, and under the umbrella of Bank Closing Committee. So examiners were assigned to the affected institutions. So they have started the process of bank closure. You know, it's going to take some days because you have to get at what we call the Depositors register. You have to get the register of all the borrowers and then the stock of fixed asset. When these are put together, then we'll make another announcement for the affected depositors to file their claims. So everything is on course, and we are in time to make sure that in less than no time, the depositors will start getting their money. Remember, the maximum deposit insured coverage for the microfinance bank for now is 200,000.
So what happens to those that have above 400,000?
Once the initial 200,000 is paid, as we continue to realize the assets, collect the loans of the liquidated institutions, realize their investment, either they had stock of treasury bills or what have you, and liquidate their fixed asset, more money will be given to them. But the first thing, by law, we have to give to the depositors is the initial insured amount of the 200,000. So depending on the viability of the closed institution, if assuming you had 500,000, and the cost of realizing the assets of these closed institutions, you can get the entire, the remaining 300, getting the entire amount. So it's a function of how viable the closed institution is.
Now, I want to even ask, how did we even get here in the first place? I mean, talking about these institutions that have been closed, 42 of them. I mean, what exactly is closure? It's not the COVID-19 pandemic, because some of them are said to have closed shop as far back as 2-3 years ago. So what really happened?
Banking is like any other business. It has its own ups and downs. So when you look at the downside is when the assets of an entity is unable to meet the liabilities. So to that end, something must have gone wrong. So from our analysis, from our review over the years, the fundamental thing that creates problems for supervised entities, licensed banks, is their inability to have what we call good corporate governance. I'll break that down. Good corporate governance is the hallmark of any successful business. So you must have the right board, the right persons, thinking right, with the right management staff that are able to optimize the resources of the bank. What do I mean? Once money are collected from the customers, they are expected to be given out as viable loans to eligible borrowers. So if something is not done correctly at this point in time, that the loans given are not given to people that have the capability to pay back, because a good loan should be a loan given on the basis of cash flow, that the business will have the ability to pay back, not on the basis of collateral. So if bulk of the loans becomes non-performing, what we call non-performing loans, then it's a trigger that all is not well. So what I'm saying in essence is that the banks that are having problems are those that have issues with their corporate governance. That dovetail in they're having what we call poor asset quality, poor loans. And that will affect the ability to service the depositors, which means the poor loans affected the liquidity, the cash flow of these institutions. So by so doing, you discover that instead of the banks meeting their daily expenses based on the revenue from the business, with time they start taking money from the depositors' funds. So they will have what we call negative capital and also illiquidity. So the bank becomes both insolvent and illiquid. At that point in time, the critical threshold of capital adequacy that should be positive 10%. Such an institution will not achieve that. And also their NPL, the non-performing loans, will be above the 5%, which is the CBN's threshold for quality assets. So when such happens, you discover that there's nothing you could do. It's just a question of time. The bank will close shop. But for some of them that are able to do the right thing, they can continue in perpetuity.
But is it all about loans default? I mean, some of these banks are said to have deviated from the core mandate. I mean, the primary reason for establishing microfinance banks, which is to cater to the lower cadre of the society. But some of them are said to be, trying to compete with the big banks, so to speak. So what about this?
You see, in terms of 1, 2, 3, number one is the corporate governance issue. Number two is the bad loans. The bad loans will give rise to what we call mission drift. The microfinance institutions are expected to follow the focus of their business model, namely give loans to the retail loans to the active poor. By so doing, the business model should be such that things are done to service their market. But unfortunately, for some of them, they start booking big-ticket loans to people ordinarily who will not have ability to repay. Apart from that, that is also affecting the expenditure pattern of some of these banks. They start seeing themselves as a mini commercial banks, getting involved in big-ticket expenditure, which their revenue profile cannot carry. So over time, it's a question of time, they'll just be off the business. So that's exactly what is happening. There are a number of other issues that further hasten the demise of institutions. We talk about poor accounting controls, weak accounting system, not having the right kind of staffing mix in order to be able to predict the market, not having good strategic plan, and not having good succession plan. But top of for purpose of this analysis, the big issue is the poor corporate governance, poor asset quality that has affected the liquidity of this institution, throwing the solvency, the capital of the institution over the board.
But is anything being done to ensure that we don't have a repeat of this? Because this is not the first time. It happened a couple of years ago. So what's being done to ensure that this doesn't happen again?
In the course of our post-mortem review of some of the closed institutions, and even the live ones, we put in machinery what we call the risk-based supervision. The risk-based supervision is that supervision that potentially looks at the inherent risks that can undermine the viability of the institution. We do this jointly with Central Bank. Every year, the institutions are shared between the two institutions. So when we get into the premises of the institutions, we look at how they're doing in terms of the key issues of capital. Are they having adequate capital? The capital they are having, is it enough to carry the kind of risks they are exposed to? We look at the quality of their loan book. Also see, are they applying the necessary caution? Because there's a threshold of liquidity that a bank is expected to maintain 20%. If you are doing less than that, it's a cause for concern. If bulk of your funds is also kept in very liquid assets, that has implications for your profitability. How do I mean? Prior to the COVID-19 and the downside of reduced interest on fixed income securities, bank placements, and treasury bills, there was this kind of a hate mentality of a number of the institutions taking their money to these commercial banks. But with the sudden drop in the yield on fixed income securities and treasury bills, a number of them have not been able to quickly restructure the asset portfolio to address the essence in which they were set up, namely to create microcredits. So part of the things we do is that in the course of our examination, we raise the issue that, look, Mr. Bank, you are not doing exactly what you are expected to do. You are not optimizing your scarce resources. Mr. Bank, your asset quality is not good. You need to take a hard look at it, pursue debt collections. Mr. Bank, your capital is fast depleted. You have to put in machinery in motion to get additional capital so that you can continue operating as a going concern. So these are some of the things we are doing. And in addition, in the NDIC, because we've come to realize that the core to the survival of these institutions is to have credible, time-tested, functional risk management processes. So apart from using the flat rate way of assessing banks for purpose of their premium payment, we've introduced what we call differential premium assessment system. Differential premium assessment system speaks to that risk assessment system that is sensitive to the risks in which a particular institution is exposed to. I explain how that works. Two institutions may have the same deposit liabilities of, say, 100 million each. For Bank A, that is able to manage the risks properly, maybe end up with what we call composite risk rating of low and moderate. It will pay less premium than Bank B, that the risk is not well managed and is having a composite risk rating of above average and high risk. By so doing, you could see a healthy competition among the banks trying to do the right thing so that their premium will reduce, and by extension, they'll be able to service their customers profitably, and the shareholders and everybody will be happy.
Which is what everybody wants. Everyone wants to be happy, especially as we go into the new year. Well, I would like to thank you, the Director, Special Insured Institutions Department of the NDIC, Mr. Joshua Etopidiok. Thank you for coming on the program, and we want to wish you a happy new year in advance.
Thank you very much, and we also want to reassure the Nigerian public that the corporation is ever prepared to continue to discharge its mandate as a risk minimizer. We want to make sure that we stay on top of the risks supervised institutions are exposed to. By so doing, we'll deploy the best of tools available, and also in conjunction with the central bank, we'll put together what we call the National Association of Microfinance Bank Information Technology, which is a platform that help the MFBs to service their customers digitally. Thank you very much.
Thank you very much, sir. We do appreciate your time on the program.